Mortgage interest rates. Holy cow, what is going on? So what do you say about that, Vince?
What the hell's going on out here?
Yeah, what the hell is going on out here is for sure. Mortgage interest rates have gone up significantly. We started the year in the 3s, now we're in the 6s. This video is going to go about why mortgage rates are rising, why we've arrived at this place here in June 2022, and where we expect rates to go for the rest of the year going forward, and why it is still a very good time to buy a house. For this is your first time here, I'm Emmett Dempsey with Treasure Coast Mortgage here in Port Saint Lucie. I'm a mortgage broker and owner, and I would love to help you and your family buy your next house. So let's go ahead and talk about how we've arrived here. The key word is inflation. I'm sure you've seen it all over the news about inflation, how everything's up, gas prices, etc., etc. But I'm going to go over exactly why inflation affects mortgage bonds. And in case you didn't know, mortgage interest rates are not based off the Fed. Yes, the Fed raised their federal funds rate 75 basis point, but it didn't affect mortgage interest rates. So mortgage interest rates are based off of mortgage-backed security prices. Now, a mortgage-backed security is effectively a bond. So what is a bond? It's effectively a piece of paper that if you buy this piece of paper, you're going to get a stream of payments. Okay, so there's a bond market where every mortgage that is done that I do, it gets packaged into a security that's traded on an exchange, and it's bought by big investors. And who buys these bonds? Your pension funds, insurance companies that have millions of dollars of millions and billions of dollars of obligations that they had to pay out. So they take the cash that you pay in premiums and then they invest it into a safe return. So that's what it's basically a search for yield, as they call it. So these mortgage corporations, insurance companies, etc., they buy these bonds. So what happens with inflation is that the value of your dollar is less every year. So ordinarily inflation was about 2-3%, and so you can have 2-3% mortgages, and it can be sold on open market. But now you have 8% inflation. And why we had this volatile rates lately is because we thought it had peaked. So when you're a bond buyer and you say, wait a minute, 8% inflation, I'm going to sell these bonds and go find something else. I'm going to hunt for yield somewhere else. You can do high yield corporate bonds or something else. I have my cash and my folks that I'm responsible for. I have to find higher yield, and I'm not getting that in mortgage-backed securities. The Fed's not buying them, so they're not supported, not creating a market for me. So in order for me to buy your piece of paper, I'm going to require a higher rate. So on a bond, the bond price is inversely proportional to the yield. So as the price of bonds goes up, the yield goes down, and vice versa. So it sells. So I mean, kind of the same way as a stock. As the price gets cheaper and cheaper, it helps to find buyers to support the price. And it's equilibrium of buyers and sellers. But what happens with bond investors, they kind of get scared when they see inflation rates and things of that nature. So they end up selling these bonds and not rebuying them significantly until the yield is high enough to support it, and then it drives the yield down. It's kind of ebb and flow, and that's how it creates the mortgage-backed security market. So rates right now they're in the 6s, and govies are in the 5s. But when I first started, the rates were in the 7s. So I think historically, we're in a good channel. So that's how we've gotten here, okay? And where I think we're going, inflation has to peak, and the Fed in raising the interest rates, the federal funds rate is an attempt to stem the inflation. So there's a few more tools that they need to do, like raise the reserve requirement for banks that happened after COVID. But effectively, we're coming off a hangover for COVID relief. And that's kind of effectively what's causing the inflation. But until they tame inflation, this is not really going to change. And history has shown, and in my interest rate video I did at the beginning of the year, just ignore what I said about the rate, but the actual spirit of it when I talked about periods in the 70s and the 80s, about what the Fed had to do during times like this, in the 70s and 80s when rates were double digits. That what they had to do to stem inflation is raise the rate, and it caused pain in the markets. So this is the pain that we're having to feel right now. That we had to take the pain off during COVID and relief and fund all the SBA loans and things that were given out. The bills come and due. So that's that's causing the inflation. And then how the markets react to the inflation is by selling those bonds, not rebuying them. Just like any other trader does. They try and find the best yield and the safest yield. Which is why they buy mortgage-backed securities and treasuries, because generally speaking, most folks make the mortgage payments, especially now you have historically low delinquencies. And as far as why it's a good time to still buy, and if you go ahead and search Dave Ramsey and best time to buy, even he says so, because demographics and inventory are still not in your favor if you're a buyer. And everybody thinks it's going to be like 2008 all over again. But back then you had my generation, Generation X was coming through, and there weren't enough of us. And then millennials are bigger than the baby boomer generation. And they're coming through now, forming households and demanding housing. So just when they're coming through, you have a historically low inventory as well, because we had 15 years of no inventory. And I talked about this on several videos, and those facts haven't changed. Okay, so so we might appreciate slower. Okay, we're not going to be as red hot as we were. Rising in rates definitely took some took a lot of that excess demand, that frothy demand. So some of those buyers are on the sidelines, waiting. But ultimately, you still have a lot of buyers and not enough sellers. So, and that's what happens in the market. So if you had the only this is the only piece of paper in the world, I could pretty much sell it for whatever I wanted, right? I mean, that's kind of, we know these things to be true. I mean, we understand these concepts, but this is just on a macro scale. So that's why. But also, where else are you gonna move to? Because rents are rising alongside, and with survey of consumer finances, homeowners are 46 times wealthier than renters, and since they have that, and the interest rate on rents 100%. So, ideally, definitely try and buy a house. I know you can't have a crystal ball. I mean, unless you're the Avengers and Tony Stark and you have a time machine, you can go back and change and buy, when rates were low, you can't do that, okay? So buy the house now, and it's like Dave said in his video. Rates come down, you can refinance. We're going through a cycle. So it's still a good time. If you have any questions, if you're looking to buy a house, sell a house, you want some actual hard numbers for what we can do for you, definitely give me a call. Go to DempseyMortgage.com. Shoot me, call me, text me, and whatnot. But wanted to thank you so much for watching. Hang in there. If you're in the home buying space, it is a good time to buy. I'd love to help you and your family if you move to Florida. Thanks so much for watching, and I'll see you in the next one.